Mortgage managers are back, at least according to some. With the market outlook looking somewhat more positive, many experts believe this is the group that will bring competition back to the market. Mortgage House Managing Director Ken Sayer says he believes that time is now.
Mortgage managers are in full flight right now. My understanding is that banks' market share has peaked, and non-banks and mortgage managers are taking some of it back as we speak. They're just doing what they did before. They're working closer with clients, closer with brokers.
Where the public ran scared away from mortgage managers and securitized lenders in the past and went back to the banks because they were scared about their rates rising above the RBA. Now that Westpac recently went 45 points, 20 points above the RBA, so the public then thought, well, hang on a minute, maybe they're all the same, and I'm not going to stand for that. I'll have a look at what else is out there. And as mortgage managers and non-bank lenders were coming back into the market, the public realised there is a better alternative out there, and we're now seeing that in our loan volumes as well.
I've tried to see what the brokers need and provide it. And if a bank's doing something well, I copy it. If the bank isn't doing something well, I try and improve on it. We've really focused on having a good range of products, having the type of products that the market is looking for in the future, like the NRAS product and the SMSF products, and also providing a really high level of service and make it easy for the broker to access us.
There's no doubt the world has changed forever in terms of credit availability. But the players in the market have changed too. The global financial crisis forcing many mortgage managers to close their doors. Acuity Funding's Managing Director, Ranjit Thambaraja, says while we're not going to see a return to pre-GFC conditions, the current state of the market should see an increase in the number of mortgage managers and non-bank lenders.
The trend is there'll be more coming in. The funding is getting a bit easier, and when that's tied with some of the banking policies getting tighter in terms of volumes, in terms of expecting a higher level of expertise from the broker, it gives a great opportunity for mortgage managers to come in, where they could actually help a lot of the new brokers that are coming in, and also those that haven't had a massive loan book built up prior to the GFC.
They have come to understand the global aspects of funding. They've come to understand that there is now a price for risk, whereas once upon a time it was dismissed. And in the old days, it was a broker or a mortgage manager would use a generic phrase that went like this: it's 80% who's a good customer, what's your problem? Those questions aren't asked anymore because we all understand that there is a downside.
Those days of come in and we'll give you a loan, they're long gone. We focus on more full doc applications, trying to stay away from low docs because we don't believe that those kind of low doc products are the best lending in today's market and going forward. So 100% of our loans, generally speaking, or 98% if you like, are all based on a full doc basis, where we obtain all the information about the client, put it through stringent calculators on serviceability, credit scoring tests on their history, etc., and come up with a credit decision.
So it seems cautious optimism is the name of the game. David White from Australian First Mortgage sees positive outcomes for mortgage managers over the next 12 months, as they and other non-bank lenders look to claw back some of the business from the banks.
So competition will certainly be there going forward. Interest rates are more stable across the board now. It's a matter of non-bank lenders still promoting themselves more in the public face, and the public accepting that there is an alternative to the banks out there. As we know, the banks are still writing about 90% of the market, maybe a little bit above 90%. Going back to the days pre-GFC, banks took about 80% of the market. So you're talking 20%, an extra 10%. That's a lot of volume in billion dollar market. So we see the competition stabilising now, coming back into the market, and that's settled down. Our volumes and other mortgage managers and non-bank lenders are certainly going up.
The next 12 months, I believe, will improve. I think we'll have more competition coming into the market. I think policies will ease a bit, enabling us to consider a wider range of clients.
There's short-term memory and there's long-term memory. While risk managers and hedge funds and investment banks can still remember the consequences, credit will be very tight for some time. But as soon as the next generation or the next team comes through, there'll be more understanding and a relaxing of. I think once risk is accurately priced, the good days will return.